let's talk about the US market and take our discussion on US and emerging markets forward with a very special voice joining us on the show today. Brian Jacobsen is joining us on the phone line from US. He's the chief portfolio strategist at Wells Fargo Funds. Remember, Wells Fargo is one of the largest asset managers and asset allocators in US, billions of dollars being managed there. Brian, good evening and thanks a lot for chatting up with us. Let's start by understanding what's happening in the emerging market scene right now. We were just discussing how India is in pain right now, and so are some of the other emerging market peers. In fact, not only stocks but currencies are also under pressure. How are you analyzing the factors which are leading to this kind of a performance in currencies and stocks and EMs?
So as far as coming out of the U.S. presidential election, U.S. equities and the U.S. dollar advanced significantly, but it was to the detriment of many emerging markets, stock markets, and their currencies. A lot of that, I think, centers around the idea that President-elect Trump, while he was campaigning, talked a lot about wanting to impose tariffs or renegotiating some of the United States trade policies. That was most evident in moves in the Mexican peso, which depreciated significantly after President-elect Trump won. I personally think that some of those fears are overdone. The reason is even though President-elect Trump has campaigned on a pledge to renegotiate these trade arrangements, he has to contend with the U.S. Congress. The House and the Senate are controlled by the Republican Party, and they are probably not all that sympathetic to the idea that we need to sort of throw out all of our old trade deals and go back to a period where we effectively close off our borders to the free movement of goods and services. So I think when push comes to shove, the reality for 2017 will be that we'll see President Trump at that point back away from some of his tough talk on trade, and that could actually be a very big net positive for emerging market countries and even their currencies.
And we sure hope that's going to be the case. But let's talk about, what's happening with markets in your part of the world. They seem to be hitting a record high every other day. The jury is, I suppose, not out yet on whether or not there is more steam left to this rally. How are you viewing it? Is there more room for this Trump rally, so to speak, to run, or is it looking a little overstretched?
Yes, I think that the U.S. rally actually does have some legs to it, where it can continue from here. I do anticipate that we could probably see what has been called by some people the Trump bump up in U.S. equities, hand off to a Santa Claus rally. That's typically in the 7 trading days after Christmas, which we're rapidly approaching here, where we, on average, about a 1.4% gain in U.S. equity markets. That's going back to the early 1960s. And I think that we could see that continue. People don't have a big incentive to try to sell any of their losers for tax loss purposes because people are expecting, hey, tax rates in the United States might be lower in 2017 than 2016. So I don't think we're going to see a lot of selling pressure going into the end of the year. And then a lot is going to hinge on the first 100 days of the Trump administration. When he takes office in late January, he's going to have to, I think, push through a rather aggressive agenda to make good on some of his campaign promises, especially related to corporate tax reform. I expect he'll be successful with that, which means that I believe the S&P 500 could actually rally up to 2,400. Now, if that happens, then I would expect that maybe things are getting a little stretched. And that's when I would anticipate that we could have a pullback, if not a correction. So it could be one of those years where coming out of the gate, it starts really well, really aggressively. We encounter some resistance and turbulence, and then it could perhaps finish 2017 on a strong note.
Brian, you're a keen India watcher. Let's shift focus and talk about India, where investment thesis seem to be getting a bit shaken. The market is falling almost on a daily basis, today being 7th day of decline. And we all know the slowdown concerns which are plaguing the market right now. What are your thoughts on how things are playing out over here?
Yes, I think that the slowdown that we're seeing in some of the data coming out of India is transitory. So I don't think that it's a permanent shift to a lower pace of growth. I'm still optimistic about some of the reforms that we could be seeing as far as with the goods and services tax, also some of the reforms as far as with Modi's program for Make in India. One of the areas that I'm still very interested in investing in is in industrials and also related to infrastructure. Year to date, it looks like some of the areas that have done very well have been materials and energy. Those areas that have done quite poorly year to date have been telecommunications and information technology. And I think that going forward, we could expect to see industrials, which so far are down year to date, those could advance pretty decently in 2017. When I look at some of the charts, I think that maybe what we could anticipate is that the weaker rupee is likely going to help some of the exports because a weaker currency can sometimes make it easier or more profitable to sell goods and services outside of India. So that could actually be a net benefit, but it also does have effects as far as increasing the cost of imports. One of the biggest imports is with the crude oil. We've also seen those prices go up. Now, thankfully, India's economy, one of the biggest exports is refined petroleum products. So it's really about the margins between when you import the crude oil, convert it into a refined product, and export it. That's the area that I think has done quite well so far. I think those gains may be moderated. But the broader economy, I think, will continue to improve, and that should, I think, redound to the benefit of especially the industrials and machinery area.
Right. You know, Brian, historically, you've been very constructive on India, and especially in the last few times that we've had a chat. But do you think that some of these transitory factors that you yourself alluded to are chipping away at the confidence in India as an investment story? You know, have you had to maybe alter your allocation strategy?
Yes, I think that a correction in India would be an awful lot like what we should expect for a correction more broadly for the emerging markets, because I think it's been mostly driven by the common macro theme of what's going on with U.S. trade policy going forward. There are, of course, country-specific issues that have to be contended with. Demonetization was one of them that you had mentioned before. But the bigger macro picture, I think, for the emerging markets is one where I'm anticipating maybe the dollar could strengthen about 2 to 3% more, and that, I think, would signal a turning point for the emerging markets. So if we see a little bit more dollar strength, I think that could maybe signal the end of a correction in the emerging markets. My anticipation is that that should occur within the first month of the new year, so sometime in January. And I personally think that that would represent a good opportunity to go overweight emerging markets in general, but especially going overweight India.
Brian, what's your net view on demonetization, which has been undertaken by the current government? Certain section of the market is hailing it, the other section is criticizing it. What exactly is it in your view, good, bad, or ugly? And how much time would it take for its aftermath to settle down and the economy coming back to normalcy?
Yes, yeah, the consumer spending and industrial activity in general has been affected by demonetization. And the biggest reason is it's effectively a form of a massively contractionary monetary policy. So it took me by surprise. It took, I think, most people by surprise when it happened, which was almost by design, because if people anticipated it, then it wouldn't have had the effect that Modi wanted, which was to kind of capture some of the black market activity and some of the tax evasion. So he wanted to kind of spring this on people. Now, thankfully, demonetizations and these rapid contractions in monetary policy are typically transitory if the central bank doesn't continue with this policy. I was a little unnerved when I saw that at the most recent RBI decision that they decided not to cut interest rates in order to offset some of this monetary contraction. However, they probably didn't need to do too much because the U.S. was going through a phase where it was quite clear the Federal Reserve was going to increase interest rates. And as a result, monetary policy tends to be a relative game, where if the U.S. is raising rates, India, if they just keep them where they are, that's effectively a monetary easing in India. So I would expect that most of the negative effects on economic activity from demonetization are likely going to be transitory, only affecting economic activity in the fourth quarter of 2016. You may see a little bleed over into the first quarter of 2017, but I think that's almost a worst-case scenario. So I think that things will adjust rather rapidly from here, and India should get back to its faster pace of growth.
Right. And Brian, last but not the least, we'd like to cap this discussion off with, what your outlook for the new year is. It's fraught with a fair amount of, uncertainty. But how do you suspect the appetite for risky assets is going to play out?
Well, I think that the biggest call is that some of this big adjustment up in interest rates that we have seen in the United States may be slightly overdone, where we can expect interest rates maybe to stabilize where they are. I would not just take the recent trend from the presidential election and extrapolate that out into the future, assuming that, well, we've already passed 2.5%, 2.6% on the 10-year Treasury, and now 3% is just around the corner. I think we could actually moderate interest rates here in the United States, and some of the damage done to emerging market currencies could be mostly behind us. So if I had to say one thing that's my biggest outlier call from the consensus, is probably the outlook for emerging market currencies, that the damage is likely done, and 2017 could be a year where we see a rebound of not only the currencies, but even in their equity markets.
Right, Brian, we leave it at that. Thank you so much for taking time out for us and speaking to us exclusively here on Smart Markets.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.